Hi, I'm Matthew Williams, Senior Investment Advisor and Portfolio Manager. I run an independent wealth practice called Williams and Associates Wealth Stewardship at Richardson Wealth, focused on long-term thinking, stewardship, and cutting through the noise. A big part of what I try to do is step back and learn publicly alongside my clients and peers from thoughtful investors. And today, I recorded a video really with the purpose of reflecting on Warren Buffett and the lessons, the enduring lessons that he has left for our industry as he's stepped back and retired. Because it certainly feels more than just a headline. So it is a natural moment to reflect on what actually endures in investing beyond personalities, cycles, or predictions. This conversation wasn't about markets or forecasts. It was about judgment, discipline, temperament, some of the core investment principles that we could all learn from Buffett. I sat down with Faisal Ahamed, portfolio manager at Canso Investment Counsel. Um, but Faisal has spent over a decade at Canso working his way through research, analysis, and portfolio construction. And what stood out to me wasn't just his experience, it was how calmly and clearly he thinks about risk. Canso is one of Canada's most respected independent investment firms. They're deeply bottom up, so they really take the time and put in the work to understand what they're investing in. Now they are a bond manager, so they are credit focused, and they are explicitly obsessed with avoiding permanent capital loss, very much like Buffett. Even their decision to operate outside of downtown Toronto's financial core reflects their overwhelming desire to be independent, very much in the Buffett tradition, as Buffett was located in Omaha. Um, I'd say, we spoke a lot about temperament and how behavior matters more than brilliance. We spoke about liquidity and being able to take advantage of opportunities when they arise, and humility. Um, you know, I'll also say for those who don't really think about bonds a lot, there's a lot of good discussion in there about investing in bonds and how to make money, how you could think about making money in bonds. So I think that's quite useful as well. So look, I think this is a thoughtful reflection on Buffett's legacy and what actually matters for investors going forward. I hope you enjoy the conversation. Today, I'm joined by Faisal Ahamed, portfolio manager at Canso Investment Counsel. Canso is one of Canada's most respected independent investment firms, known for its long-term fundamental approach to credit, risk, and capital preservation, a philosophy that resonates strongly with many of the principles Warren Buffett has spoken about for decades. Faisal has been with Canso since 2013, becoming a portfolio manager in 2022. He has a very diverse professional background, which gives him a grounded, real-world perspective on businesses, balance sheets, and risk, a great lens which to discuss Buffett's legacy and what it means for investors going forward. So firstly, Faisal, thank you very much for doing this and joining me today. Can you give the viewers of our video today just a bit more background on yourself and Canso before we start digging into to heralding Warren Buffett?
Absolutely. Thanks for the introduction, Matthew. My background, I actually worked for a few different businesses before coming to Canso, and in the operation side of things, and being at Canso, I've had many different roles, as we do at Canso. We're located up in Richmond Hill, so north of Toronto. Consider it the suburbs, not down the core, and that's purposeful. For one, we're quite independent when it comes to thought process. Second thing is we're bottom up, deep value investors when it comes to credit selection. So we always look at credit and cash flow. So we're investing in the debt side of things and lending to businesses. So we always look at the character of the business, how can the cash flow as well, and how can they repay us. But ultimately, what I would say actually, which lines up with how Buffett invests, we like to take risk, and there's always going to be volatility through different market cycles. But we always want to make sure that there's not that permanent capital loss. So seeing what is the maximum downside, we actually call that our max loss. Um, My background, though, in terms of what I've done at Canso, I first joined and I worked on our client servicing area. I quickly really wanted to get into the research side of things, so looking at actual companies and what to invest in, and working on the portfolios directly. So today I work in multitude of different roles, but with clients, but also directly on the, the the portfolios and the funds that we're going to be speaking about today. And then also, working with the issuers and the management teams of those companies and discussing and sometimes doing recapitalizations and really working closely with them. So, there's a lot of parallels between, I would say, how Buffett has run his, investments and what we do at Canso.
Great. No, thanks for that. I guess we can first start off with something, a bit more reflective, and then we'll certainly get into a whole bunch of, investment focused or investment lesson pieces. But, when, you and I were talking about kind of the last kind of, investment letter that he's written, and of course he's been preparing for many years for this transition. But as you sort of think about him sort of stepping away. What sort of stands out to you, not just as an investor, but as a person? What do you think, the best message, he'll be kind of carrying forward, through his final message?
Yeah, you know what? The final letter it was interesting because he's always got hidden type of messages and how he explains his stories, and he goes into talking about you know how he acknowledges luck. He was born into a great area. He always talks about this throughout all of his career, essentially. But he recognizes that you need to have effort and skill, but you can't downplay where you came from and where you were born. And he even says to the point where if he was born in a different country at a different time, things could be much different for him. Even though he has that skill and aptitude to do what he does. So I think that's one thing to think about. One of the parallels for us when I look at this too is he talks about his environment and where he's moved around. He went to New York for a bit and he came back home. But that's similar to what we do in Canso. I mentioned earlier on that we're located in Richmond Hill. I mean, that is very tactically purposeful and in what we do. If we were downtown Toronto, you get in an echo chamber almost where the ideas start bouncing off each other and you're not independent with thought process. And for us, we really designed it this way. And I think he's done that purposely as well, to be quite independent from that type of thought process. When you churn your portfolio over and over, you can lose value. And when we lend to companies, it's a little bit different than buying an equity, holding it forever. But when we buy something, we always look at the entire situation. We'll buy it and expect it to hold until it matures. There are sometimes better opportunities from a spread standpoint where we can pick up value, but that's something that we look at very closely. I think another thing too he really speaks about too is longevity. How being it for the long game here, right? And not churning that portfolio. So volatility, he's always mentioned this. Volatility is something that is survivable. And something that we look at too very closely. And today, for example, over the past even 2-3 years, the market's been extremely volatile from a yield perspective. Credit spreads have come in tremendously. We're at, call it, I would say, near record tights on a spread level on a high yield basis. And for us, we need to be very disciplined when it comes to what we do. And what separates us, I would say, from other ways of investing is that when there's an opportunity, we're ready for it. We have a very strong discipline at Canso. I think that obviously Buffett has a very strong discipline in what he's done historically as well. But I think that is something that's extremely, when I look at how he invests and how we do things, there is a very strong correlation there, having a strong discipline. If you look back historically, we always, if you read our newsletters or any of our publications and how we do things, we look at historical spreads. So if you go back to the 1980s and you look at average spreads of, say, a triple B or a single A, and you know where value is, that's how we have discipline. And we're not going to go waste capital in these very expensive type markets when we could take advantage when there's eventually a move. Markets do have volatility and there will be ebbs and flows, and it's just about timing that properly.
Yeah, perfect. And you hit on a couple of things there, and we're certainly going to circle back in a couple of questions towards that sort of being opportunity ready and having liquidity uh, from that perspective. One of the things you mentioned there too was just his acknowledgement of luck. I mean, so one of my favorite authors is Nicholas Taleb. I end up, he's for the audience, he's the author of Black Swan and Anti-Fragile, which is probably my favorite book. But I reread one of his books each year, and the one I've decided to begin this year with was Fooled by Randomness. And it's always funny to kind of come back to this idea of randomness and luck kind of playing a role in investments and life in the world, so on and so forth. And but you do the right thing over a long time, that longevity increases your opportunity for success. You kind of touched on this a bit, but maybe we dig a bit deeper. So Buffett often speaks about and believe that temperament mattered more than intelligence. In your experience, and even within Canso, what does good temperament actually look like when markets become uncertain or emotional?
Absolutely. I mean, I just want to go back to even your yeah, in terms of temperament and emotion, I think there's overconfidence as well. Have humility when it comes to investing. Um, if you go back, Mike, you mentioned books, but Michael Lewis, he speaks a lot about testosterone and how you can go into situations where you don't even know that you have this innate way of trying to compete and always do better than anyone else. But I think it comes back to you mentioned here temperament. So you need to really have that disciplined approach. And what we do is we look at for example, right now we're sacrificing 3-4% of additional yield in our portfolios by being much more high quality. High yield has performed very well. It's come in, it's tightened in, and we've sold a lot of our high yield into strength. So taking advantage of opportunities when there's liquidity, we take advantage of it, right? And within the fixed income markets in Canada and even in the US in the high yield space, there's not always that liquidity available. So for us, um, markets in my view, will reward discipline much more often than trying to outsmart it, being too clever for what it is. And I think he speaks about this. He talks about, you talk about temperament. He's worked with Charlie Munger, Don, Walter Scott, and he talks about that in his final letter. And they're all really smart people, but they're patient and they take their time and they're very disciplined in their approach. They'll have conversations where it's even a bad, not call it a bad company, but a company that's struggling, but they'll retain in their portfolio. And we look at this it's similar way. We will go into situations where no other investor wants to buy these, or lend to these businesses. Take, for example, Hertz, Credit Suisse, when everyone had it was bad news. We're lending to Credit Suisse, but we've done our homework. We have 33 different people on the investment team looking at any given situation. So that's where our team, I would say, excels, and there's a parallel there. So that discipline is extremely important, I would say.
That's that actually I'm really glad that you mentioned that in those examples, and maybe we can even, maybe you want to even dig down a little bit further in there, because really my next question is really going to be about independent thinking. You mentioned about, not, there's some companies that maybe the average manager or the average portfolio manager doesn't really want to get near, but you're willing to do the work and have sort of independent thinking or independent or unique perspective on some company. So, really, like, why do you, maybe the inverse of that is, why do you think it's so hard for most investors, most portfolio managers to stay calm and think independently when the crowd is doing something else?
That's a great question. I think we were established in 1997, and I think one of the most important thing is, and similar to what Buffett has done, is making sure that your clients understand how you do things and why you do it. So for us, unlike other, call it maybe potential managers, Credit Suisse, I'm just going to use that as an example. it had extremely bad headlines. I mean, even Hertz had terrible headlines at different points in time. And for us, usually that invokes opportunity and where we can find opportunity. And it's not to, you need to make sure if you're going to lend to a company that's in trouble that you structure extremely well. So that's one thing that we'll do. We'll work directly with the company to structure these deals rather than just taking the fly by the night type of deal that comes on at your normal cadence. So we will, in Credit Suisse example, when there was opportunity, what I would say is a lot of funds were selling it to get out of their portfolio because that's going to create difficult discussions for them, the managers, and their clients. And so for a weight that potentially is not too large in their portfolio, we were taking a large conviction weight in our portfolio because we had done our homework. We established that we would buy the senior holdco bonds of Credit Suisse. And we believe it is investment grade. So when you look at an investment grade issue, typically that spread over your nominal is quite suppressed compared to a high yield issue. But these bonds were starting to trade in the high yield space. So call it 450, 500 basis points above your risk-free rate. And just to give context here, these bonds should trade maybe 150 basis points back of the nominal curve. And so for us, that was a great opportunity. Now we did avoid losses though, because there were these other bonds that they hold, and similar to the banks in Canada, there's additional tier one capital, which is just a class of capital, but the notes in different banking regimes are structured differently. So in the Swiss banking regime, those notes are actually called write-down notes. So instead of being converted to common equity of the bank, they are actually converted to, they would be written to $0. And so this actually happened. And there's clients that purchased these, not our client. We didn't do it. We avoided them because we actually read the documents. But people bought these and they're providing a much higher yield and spread than what we were buying in the senior space. But we knew that there was that risk of permanent loss that we did not want to incur for our portfolio. Those were actually written down to $0, whereas we've recovered our capital. So there's even bonds that we were buying, in distressed prices of 3 months until they mature, and they were trading at 75 cents on the dollar. So picking up extreme value here when there's people who sell into into weakness. We like to buy into weakness. And I think that's something that I think being contrarian, not to be contrarian, but being independent in thought process to take advantage of opportunities.
Yeah, no, that's great. And I think, for many of our clients watching this, and maybe really the investor base at large, when, a lot of people, when there's discussion about markets or I mean, a lot of your average investors don't sort of spend a lot of time thinking about bonds, but we're so conditioned now to think about the index, what's happening in the market, what's going on with this geopolitical, this or that. But really, a number of items that you just mentioned there was really just about doing the work, right? Like there's an issue, there's a similar issue from the same company. You read the documents, you picked up this one instead of this one where others were going. This one writes to zero, and you recover the capital. And that's just the difference between doing homework and not really. I mean, obviously,
Oh, totally. Yeah. And
so
that's, if you just look at the headline, call it, characteristics of what you're buying, we're really not doing our work as a manager. So for us, on every single issue, just to break it down a little bit further, we established a credit rating similar to a rating agency, but that's our own independent rating, and that derives where we think it's applicable to put in from a risk perspective, and then also we do our max loss, and this really comes down to permanent loss potential. And so on the worst case scenario, we always establish what can we recover, and we have a very simple scale at Canso. It's a scale of 1 through 5, and a 1 is where we recover anywhere between 80% and then increments of 20% all the way down to a 5, and a 5 is where you recover anywhere between 0 and 20%. Now, 5 doesn't mean we're not going to buy that type of issue, but it means that you need to size it appropriately for the portfolio, and you're usually compensated at a much higher yield, or call it spread, when you're buying these types of issues. So it comes down to reward and risk, and how do you balance that out?
right, absolutely, absolutely. And then I guess coming back to opportunity ready, Buffett often talked about the value of being prepared. Uh, sorry, having the patience, the clarity, and flexibility to act when opportunity arises. Um, I think, for instance, you mentioned earlier that, right now, you may be giving up some yield, just based on kind of the opportunity set because, you're being a bit more conservative. I think of at the present moment inside Berkshire, there's a lot of effectively cash equivalents in there, probably the largest, I think the largest from a percentage standpoint that they've ever had. So there's a willingness, I guess, in both cases, there's a parallel there around being very thoughtful about your liquidity position, being able to hop on opportunities. Can you speak to that a bit further?
Absolutely. Yeah, I think it's just funny you say that they're at the highest they've ever been, but we are as well. We've never been higher in liquidity than we are today. And that's just a reflection actually of value. And so if you're not compensated for the risk, we're not going to take it because that goes back to that disciplined approach, and rather than trying to be clever and pick up yield just for the sake of attracting investors. For us, we have unit holders. We are unit holders, and our family are, and so we want to do the best thing possible for long-term preservation of capital. And so when you do that, I think it really comes down to finding the best opportunities right now. And when you look at what is good value today, rather than saying what is the best yield, because yield and value are different, right? Because there's risk. If you look at historical spreads on the high yield basis, we're at close to all-time tights. So you're picking up 350 basis points over a risk-free rate versus, say, normally 550 or so. Now, if you were to go higher in quality, even to triple B, triple B is the lowest within the investment grade, called the safer space. And those spreads are also at pretty tight levels, particularly in the long end. But then as you look at, say, single A, which is higher quality, and then double A and triple A, you actually get to closer to average long-term value. So for a double A today, we're very close to long-term averages. And that's where we've been investing in the corporate space because we have Canada bonds and U.S. Treasuries, depending on the portfolio, if it's Canadian or U.S. dollar based. And then we have NHMBS, which is federally backed National Housing Act mortgage-backed securities. And so you're picking up another, call it 35 to 50 basis points, depending on the issue and the weighted average life. And that to us is very good value because it allows us to pivot out of, call it high quality, while we're still being paid today to hold those issues, but be able to pivot into opportunity. And so we never want to, the other thing I wanted to say here is when you have high quality, it's a little bit different than you said Buffett has cash and equivalents. I would consider this our cash and equivalents because quality to us means liquidity and being able to pivot quickly and take advantage of opportunities. If you go back to the most recent, call it period when there was a lot of, call it opportunity, it was the pandemic. And things came extremely quickly. There's a lot of uncertainty there, but when you have a disciplined approach, we stay calm, collected. We look at businesses, we see what's the value of them on a long-term basis, and then that's how we add value in the portfolio. So if we think that they're trading extremely cheap from a long-term basis, we will add them to the portfolio. But you can't do that if you are in, call it all high yield at that period. So cash and equivalents or high quality is very important in these times when you're not paid for risk.
Great. And I guess mostly maybe for the benefit of the kind of average investor who listened to that, because I think like what you said is really important. So there's the idea of spread. So you have, a government bond, you can lend to the government at, whatever rate. And the government is sort of thought of as risk-free and or considered risk-free. And so if you're going to then lend to a corporation, double A, triple A, triple B, so on and so forth, you expect to be paid, commensurately more than what you'd, get paid to lend to the government. And right now you're finding that those spreads are pretty tight. Like you're not
Yeah.
actually getting paid enough for the relative risk. But importantly, during a moment like the pandemic, very quickly that dynamic changes. And so if you've been, high quality or have a lot of liquidity, you can then very quickly move and capture that value because sometimes those spreads blow out a long way. So where you were getting paid maybe a 3.5% spread before, maybe you're getting, I don't know,
Over a
eight,
thousand.
right? Yeah, right, a
Yeah.
thousand,
So
right? Like which is
and it
10%, folks.
it
Yeah.
moves. Yeah, exactly. So
Right.
when I speak of spreads, you have your risk-free rate, which is call it your federal government of Canada or the United States, and then you have quasi-government where you can lend to provinces and stuff like that, but there's still credit risk there. And so what we do is we evaluate where does it make sense to lend from a credit standpoint. So maybe the provinces aren't you're not picking up enough, call it yield there to lend to them. So we'll lend to the federal government, but it's in a different structure where you're paid, for this, basket of basically mortgages, right? So, if we all have mortgages, they get grouped into pools, and we lend the money there, and then that is essentially will finance a lot of the homes. Um, so for us, yeah, it's all about relative value, and things can move, as you mentioned, extremely quick, and you have to be ready to act. So it's no fluke. If you look at our quality profile in the portfolios back in 2017, 2018, 2019, and there's a period there, like that's 3 years, right? And it's not, we were high quality for a while, but there's pressure. There's always pressure, like, oh, why don't you go buy these deals and add more yield to the portfolio? But it comes back to a disciplined approach. If it's not good value from a risk reward, and just to keep it simple, we're not going to deploy that capital. So it all comes down to being paid. We need to be paid, or our investors need to be paid to lend their capital, and it has to be where they're paid for that type of risk. So for now, we'll find some scenarios or situations that we find, like, as I mentioned, Hertz or Credit Suisse, like in these periods when it's called expensive credit, there's always going to be some types of opportunities to add value, and you work directly with the issuer. But in general, you need to be extremely disciplined, and I think Buffett's done that better than anyone else in history.
Yeah, absolutely. And so you touched on you've touched on this idea a couple times around contrarianism, and I think we all love the romantic idea of going against the crowd, but in real life it can feel uncomfortable and lonely, and you're getting a lot of pressure, right, from your investors, and it's probably tough to look at the ticker tape regularly and kind of see that, maybe the market is kind of moving away from you. How can someone tell though when they're making a thoughtful, independent decision versus simply resisting the crowd for the sake of it? And how does Canso navigate that tension as you make investment decisions?
Yeah, I think it's a great question. There's definitely pressure from, say, a new investor, and they don't understand our process. I think the biggest thing is making sure clients always understand how a manager invests. So for us, we have institutional clients. We have a lot of different ways of obtaining a fund, and it's education. So they understand how we invest and our process. And the process really comes down to, as I mentioned, Canso has those heuristics in terms of value, different credit qualities, different terms, and what is average value, what is attractive, where do you have a sell discipline as well, because harvesting gains is just important to be able to pivot into cash and equivalents, or I'm just referring to the Buffettism here, and then being able to go and deploy that capital eventually. Again, there is pressure for sure. You have competitors out there, and what you can't do is compare yourself always to competitors, because what they're going to do is not what we want to do. What we want to do is preserve capital and then take advantage of opportunities when they present themselves. And that's, you don't know timing of markets. It's impossible to know. What you can do though is you can actually see what is value and have your discipline, and make sure that you hold to that discipline. So it's simple, but it's very difficult to do.
Yeah, yeah, absolutely, absolutely. And we touched on this a bit earlier too, around simplicity, and um, Buffett really kind of built his career on sort of speaking about things within his circle of competence, and understanding what he owns and so on and so forth. And for Canso, I mean, what lessons do you guys take from that idea? I know we've kind of touched on it a little bit earlier, but maybe we can expand that a bit here. How do you keep things simple without being simplistic, especially in a world where things have become more and more complex?
Yeah, you gotta you do have to look at different opportunities and keep your educating yourself there, but also sticking to your knitting is important, right? So you know what you do, you know how to do it, and if you we have a disciplined approach in how we do things, and for us it makes a lot of sense because it just for us it's fundamentally how we do things. When you see people deviate from how they do things, and really call it pander to how other managers do things and just trying to pick up yield, I think that's where you can get in trouble because then you're losing that discipline and you don't know what to do. So for us, I think when things become more complex, there are things that are complex, but if you break it down into simple terms, I always find it makes a lot more sense to sit back and look at a larger picture there. Um, yeah, there's definitely going to be times where um, you'll want to look at things that are very different, and we do get calls. That's the thing about Canso is we have a team of 33 people, as I mentioned, and we do get calls about obscure deals, and we're willing to put the work in, roll our sleeves up, look through the full indentures of the documents, and see um, where can we tighten it up to make sure that we're protected if we were to lend capital to that business.
Right, right, absolutely. And I guess now really to close off, I mean, and I kind of leave this a bit more open-ended. I mean, what are some of the, and we've spoken about a number of the enduring sort of lessons from Buffett. We talked about simplicity, contrarianism, being prepared, being patient, independent thinking, temperament. Um, what do you think, either among those or just in general, are likely to be the most enduring, or maybe in your opinion, should be the most enduring lessons from Buffett as as he sails off into this next chapter in his life, but all of us who really admire him will move forward and continue to do what we do, with his inspiration.
Yeah, it's heavy. I mean, he's so accomplished and well spoken, and I'm going to try to do the best I can to really advocate for what he believes. And I would say for us though, you know I would say the biggest thing that I would say in terms of some, we want to protect client capital. So you protect that capital, you safeguard it, because you lose it, it's a permanent loss. And that the other thing too is we're in Richmond Hill. We don't need to be flashy and be downtown. I would say being humble in what you do is extremely important because you know it can go to your head pretty quickly if you become successful and you have good returns. But you need to be humble and always stay calm and collected when you're looking at things. Um, there's fads and fashions as well, right? Things come and go, but what I would say is the way we look at things is we're unfashionable at Canso. We're not looking to be like every other investor. And so you have to think really long term when it comes to capital choices and how you're going to invest, particularly with debt that can be long term, right? So if we buy an issue, as I mentioned, we buy it with the intent to hold it until it matures. So if it's a 30-year issue, that's a 30-year investment for us. Um, unless there's potential opportunity where markets move, and we mentioned how you have spread movements here. So essentially it really comes down to a disciplined approach for us.
That's great. That's great. Well, Faisal, I really appreciate you doing this for us and for our clients. And you know when I think of really thoughtful organizations, investment firms, Canso is absolutely amongst the top of that list. And you do a great job for clients and our clients' capital. And so thank you again.
And me, Matthew, and your clients, we really appreciate you guys. And I always say to clients, we couldn't do what we do without clients either. So thank you for everything that you do.
Great. Appreciate it.